Hello and welcome to the Road to Autonomy. The Road to Autonomy is brought to you in part by Stantec Generation AV. Stantec Generation AV combines some of the most experienced AV experts in the industry with the resources of a global engineering firm. Stantec Generation AV provides education, consulting, assessment, and guidance to any industry interested in autonomous vehicles. Learn more at stantec.com. Hello and welcome to the Road to Autonomy. I'm your host, Grayson Brulte. On today's episode, we're absolutely honored to have Mike Stankard, Managing Director, Automotive Practice Aon. Welcome to the podcast, Mike.
Hey, thanks for having me. I appreciate the invite and look forward to having some fun today.
Looking forward to it as well because Aon's a great company, which is insuring the world. You're doing great things, insuring really interesting, complex technology. So I can't wait for you to pull back the curtain when an individual says, "Hi, I'm building an autonomous vehicle company. I'm going to put on the road of how you insure it." So thank you so much.
Okay.
Mike, I'd love to kick this off by asking you, what is the current state of the insurance markets for autonomous vehicles?
Yeah, that is a very loaded question, and I'm sure during our full conversation today, we're going to talk about different segments of the autonomous vehicle world. But overall, I would say it's pretty healthy. We and other brokers in the industry, we've done our job of helping nurture and bring along the insurance industry to embrace kind of these new risks. You know, they've been happening in technology in many different ways, but for the last 5 years, autonomous vehicles and how to insure them has been an important issue for us to tackle. So I would say in 2021 that we've got a strong handful of insurers that are committed to staying in this space for the long term and recognize that it's not a trend, but the future. But there's still plenty of work to do to increase capacity and to make insurance programs more meaningful as these companies move from testing and development to full deployments.
Are more insurance companies moving into the market now where they see a growing industry?
Well, I think, again, it's a strong handful, and there's plenty, as you probably are aware, across manufacturing and even kind of the new digital economy space, there's dozens and dozens of insurance companies that support the manufacturing industry. But at this point, certainly not everyone's on board with this, and there's plenty of insurers that are in a wait-and-see mode. So it's those that we have to continue to educate them and bring them along, maybe get them involved in a higher level risk attachment, you know, getting them involved in an easier aspect of the business so that they can experience it and get to know how these risks operate before they really delve in, you know, with both feet.
Let's use an example. Company is today in the development stage. They starting to develop a technology to eventually put passengers in there, and then eventually they start operating and testing on public roads. How does the insurance change when they go from, let's call it the R&D, to when they start putting it on the roads with paying passengers?
Yeah, sure. No, that's a good question. Certainly testing is where everybody gets started, and we've got dozens and dozens of clients that are in testing phase. In insurance lingo, that's an automobile liability risk. And again, with testing, there's plenty of oversight. It's very well controlled. Sometimes it's off-road testing on private tracks. Other times it's geofence testing within an area of a city. But they're under the microscope, and there's all kinds of risks and controls around that. So the insurance industry's gotten pretty comfortable with that. And also tech drivers in the vehicles, you know, again, as they move to a level 4 autonomous mode, which would not have tech drivers in there. So yeah, it's a big jump for removing the tech drivers and paying passengers if it's a robo-taxi type business model. That's a big jump. And certainly the risk profile of that vehicle raises dramatically when you move to that next step. So initially premiums go up and underwriters now have to do a lot more homework to get more comfortable with the risk. But ultimately, is the whole point of us being here and talking about it, is that the ultimate impact is that insurance underwriters, sooner rather than later, get to a point where they say, yes, these vehicles are safer than a human-driven vehicle and deserves more favorable rating than historically the way they've been looking at automobile liability risk.
That's a valid point. We saw the NHTSA data that was released the other day where traffic crashes are starting to tick up again. And that's going to become a big problem. I can imagine that's going to, on the automobile liability side, the premiums will probably go up if that data continues to trend that way. We're going back to AV. So from a company that goes from that testing to charging, do its insurance companies say in the underwriting, well, we're not comfortable with commercialization, and then you put on your Aon hat and help them find a company that would be comfortable with that? And then how do you do that to ensure that there is no loss of coverage? Because I have a friend, I'll give you an example, a wonderful gentleman. He owned a restaurant in Las Vegas, and he had a lapse of insurance for, let's just call it a couple out, probably half a day. Well, that day, there was a shooting in his parking lot with an individual who was infamous and remained anonymous for this case, but well-known individual. And he had to lose his restaurant to cover because he didn't have that insurance for that lapse. So how do you avoid a situation like that with an AV company?
Yeah, sure. Well, lapses of insurance are never a good thing, no matter what side of the fence you're on. So yeah, again, it's kind of back to our role. And fortunately, as autonomy is developed over the last 5 years now, maybe even 6 years now, we've had a pretty good runway to work with insurers and get them comfortable, with this emerging risks. And it's our job to have capacity available and have enough of it available and have it consistent. However, we will see some insurers like to just insure a small, very controllable exposure. And just like any company, whether they're in autonomy, any company that's developing through their phases of growth, there's some insurers that like companies that are pre-revenue or in that $0 to $25 million revenue range. And there's other companies that only want to work with companies that are $1 billion or more. So there's plenty to go around out there. What's interesting about the companies in the autonomous space is we know they're all starting small and moving and have aspirations to move up. So that's a challenge for us. And we also have, again, there's two different stakeholders really in the game. There's the startups, with fresh capital, and then there's the traditional companies that have been in the automotive or transportation business for decades that are pivoting and creating alternatives to traditional modes of transportation. And those companies already have insurance programs and have robust balance sheets. So it's different for them to bring that full solution to them.
From the startup perspective and the established OEM that's moving into the space either through an acquisition or an in-house development, they get to the point where they're meeting with the head of R&D, and the individual running the division said, we're ready, we're confident, we're going to pull the safety driver, we're going to pull the safety engineer. I'm assuming you have to sit down with the insurance underwriters and completely price that, since this is something that's only happened in very limited circumstances on public roads?
Right, that's true. And we've been doing that all along. So there's no underwriter that's currently out there insuring the automotive industry that isn't aware that this is an emerging risk. So we've been as transparent as possible throughout the process. I think where our work gets even more difficult is when the end product, which could be a transportation as a service company or a technology sale without selling a full vehicle. In our world, that's viewed as a material change in risk. So you got an underwriter that's used to having a company that sells vehicles, provides a warranty, and they're off to being driven by the public and third-party drivers. Many of the business models going forward with autonomy, the insureds, our clients, are creating new business models. They're going to be operating their own robotaxi businesses and not selling vehicles, but selling a service. So that's where it's not just the technology, but it's the whole interface with the public that could be substantially different than the way they've been operating for decades.
Is it fair to say that some of these complex insurance programs are bespoke and built just for the client based on their unique needs and their risk profile?
Yes, yeah, you've been doing your homework. So what I like about this is the approach to insuring vehicles from a traditional standpoint has been established, for decades now, and it's pretty well optimized approach. In the case of deploying autonomous technology to the public, as I mentioned, that could be a sale or a lease of a vehicle. It could be providing a service where the insured is controlling the fleet themselves. It could be the sale of technology. All of those could be insured in a different way. And what I'm enjoying right now is that handful of companies that I talked about that are embracing this. They recognize that they have an opportunity to create an insurance program that really fits with their business model of 2022 or 2023. And if that's charging by the mile, as opposed to a revenue-based charging, they could be charging by the mile. They could be charging a rate based on where that vehicle's deployed, how many passengers are in that vehicle, what the ultimate business model is, and being able to, I think, bring more value to those customers because they can truly, in a lot of cases, insurance is out front and in the public, and to be able to provide a real value by customizing that right to their final business model.
Does the insurance change if it's an autonomous vehicle moving passengers or moving produce or moving boxes or deliveries from e-commerce?
Absolutely. There's so many different categories now. I'm thinking, there's four main categories. We tend to default to thinking of private passenger vehicles, in a robo-taxi kind of mode. And certainly many of these startups in the industry have focused around that. But there's been a lot of pivoting with companies looking at, that's almost the holy grail of, I'm probably using the wrong analogy, the perfect storm. I'll have to come up with something more negative than that, of exposures, where you've got a brand new technology, it's out on public roads, it's got people in them, and, if things go wrong, that's risking lives. There are companies out there that say, hey, why start with people when we can start with package delivery or long haul trucking, where there's plenty of opportunity out there and there's other problems to solve, including a labor shortage of drivers in that space. So yes, the approach by the insurers would be completely different if it were insuring a long haul trucking operation driving on open highways than somebody that's moving passengers around Las Vegas, for example. Very different.
Another difference that we're seeing now, some companies have gone public. One has gone public through traditional IPO. Several are in the process of going public through a SPAC to the public markets, and other autonomous vehicle companies have made public forward-looking statements that they are, quote unquote, looking into and or exploring a possible public offering. Back to the question again, how does the insurance change? Do you have to go to a larger, well-established insurer that can take on larger risks now because there's going to be public shareholders? They're going to have to put SEC reports. Is there a whole nother layer of insurance that has to live on? So you have your operational insurance that's operating your autonomous vehicle service. And then do you have another layer that says, okay, this meets SEC public markets requirements? Then you have your board of directors and all that stuff. Are you building a wedding cake of insurance here?
Well, sort of, but if we take what we just talked about as automobile liability insurance and all the different aspects of how that can work, set that aside in its own sandbox, if you will. And when it comes to insuring the board of directors and the directors and the officers and other stakeholders that are involved in managing the company and, in your example, taking them public, that's a whole nother category of risk and a very different area of specialization within the insurance industry. Directors and officers liability is a broad category. That's a very specialized market, and you could have companies that are very good at that have no interest in writing automobile liability, and vice versa. So, yeah, to dig down, we could probably spend a whole nother podcast just talking about that aspect. Because when a private company goes public, the risks that the directors and officers and other investors and stakeholders are exposed to are substantially increased when you're going to be making a public offering with all of the SEC regulations and guidance that goes along with that. So it's a dramatic shift. It's, I guess it's akin to pulling a test driver out and And so that area is very complicated. And we've got, at Aon, we've got a specialized team that deals just with that. And even within going public, we've got a team that is focusing just on SPACs versus, traditional IPOs and traditional public company exposures. So it's a big part of what we do for clients. And again, at the same time, it's very different. So we're talking about one of the top risks and top concerns that investors and executives think about when they're backing a company that's pushing out new technology.
On the other side of companies going public is the mergers and acquisitions side of the house. There's going to be consolidation coming in autonomy. And you have a company that says we've opted not to go public and we've accepted an acquisition from a very large publicly traded company. Is that another layer of the insurance part, or does that fold into the existing, what they have?
Yeah, it's another threshold. It's a variation. So when a company does go from private to public, or if they go from being under their own control to a material, again, that's an insurance term, a material change in interest. What happens in the directors and officers liability space is that policy ceases at that point in time, and we effectively shut down the program that the target company or the company that's going public has in place, and we put together a brand new program going forward that addresses all of the new risks that going public is. And if they were in a traditional program and being bought by someone else, they would typically move over into the acquiring company's program. But what's interesting, though, is if you were a director or an officer of a company that was acquired, you still have exposure for the decisions that you made and the guidance that you provided to stakeholders prior to that merger and acquisition. So what we do with that program, that directors and officers liability insurance program for that team that might be going away after the acquisition, is we put that program into runoff and we give them 6 more years, for example, of coverage under their old policy for claims that could come in for prior acts, if we will, or again, decisions that were made prior to the acquisition. And then the new entity goes forward with a fresh policy. It's relatively complicated in doing that, but that's one of the, transactions that has to deal with 2 different sets of stakeholders, the directors and officers that are going away and the new board going forward.
It might be complicated, but it's extremely smart. At the end of the day, then you avoid, as I described earlier, the restaurant scenario where you don't have that lapse and you don't have an incident that comes back to haunt you, where you get a phone call one day, I have to quote my wife, and she's got a great line about this. She goes, you get the best insurance so you can sleep at night. It's the best medicine you can get because you're not going to be up all night worrying.
That's right. And I'm proud of our team that carries out that work. And many of them are attorneys. We're actively dealing with the legal outside and inside legal counsels of our clients. And many of those are, again, have legal backgrounds that wanted to join the insurance industry. So we're happy to have them, and it adds a whole nother level of expertise, that our clients need.
You shed an incredible amount of light on a topic that some individuals find boring, but frankly, I think is one of the most interesting topics in the world, insurance. Insurance markets are absolutely fascinating. For listeners, if you're interested, there's a lot of really great books on the history of the insurance markets that will open your eyes and realize how great of a market it is in the extremely role it plays, and not even in the U.S. economy, but the global economy and society as a whole. And Mike, I want to pivot back here for a second. We talked about the life cycle of an insuring an autonomous vehicle company. And let's say I started an AV company. I raised my Series A round. I'm feeling really good. We've got really great growth momentum. And I'm thinking about, my wife says, okay, you got to sleep at night. You're working really hard, but you got to sleep at night. How at that point should I start thinking about an insurance program to mitigate risk, where when I go to my Series B, Series D, the company keeps growing? I don't have to say, wait a second, I made one mistake back here that's going to come back and haunt me. How should I start to think about it when I'm at that stage of the life of the company?
I like that question, and I actually had this conversation earlier today with a client that describing their concerns when they're in that venture capital stage or in the very early seed round stage of a company. They've got high aspirations for changing the world, but at the same time, very little capital, and they're just focused on what they need to do tomorrow. And a lot of it is compliance, is contractual compliance with some government, state, local, federal government that has mandates or requirements around them relative to insurance. It could be a contract with a company that they're co-developing with, or a target client that's doing some early work with. They might require insurance things. So it goes from that to, at some point along that path of evolution, it's, I need to protect the capital in this business. We've raised enough capital. These risks are moving from conceptual to reality, and hopefully they call in a company like Aon to help them better understand that, and then really start to going from insurance purchasing to really developing risk management strategies and best practices as they move to full operational phase here. So that's where, just like any business, we've got all different levels of expertise that we can align with companies depending on where they are.
Do those insurance risk mitigation strategies and policies go all the way down to the HR level?
They can. I mean, Aon has, three major solution lines that we work with: risk, that I speak mostly of, retirement and wealth, and then the other one would be health solutions, employee benefit and health solutions. And so, absolutely, I think one of the biggest risks in a rapidly growing company is attracting and retaining top talent and getting the right people in. So obviously, HR is challenged with building that business up to scale and keeping up with the growth, the thought leadership growth of the company. And all of a sudden it's like, oh, we have to staff a factory now with 1,000 people because we're ready to go to production. That's quite a challenge. And we've got solution sets with an Aon that can align with each of those areas.
Is this where you and your team go and meet with Mr. and Mrs. CEO, Mr. and Mrs. Founder, and talk about the risk profile so you can completely understand what the company's growth trajectory is? So when you sit down with the insurance markets representing Acme Company, you can properly explain to them. Is that how that process works?
Yes. Our client service model at any scale starts with a continuous feedback loop of discovery and understanding of where business are going, whether it's two men in a truck to a $20 billion organization. Our process really is the same. We sit down typically 90 to 120 days before any type of insurance transaction and gets the whole story and provides them with what we view as the whole story related to where the market is today, and provide, again, guidance on how to be viewing their risks today on a pathway to what those risks are tomorrow. So it's a healthy, I can't imagine not having that conversation with our clients and doing a competent job of protecting them.
How are the insurance markets currently pricing autonomous vehicles, autonomous trucks, and autonomous delivery robots? Are we seeing in certain markets, I know in the Florida flood market, you're seeing a tightening of the market and prices going up. Are we seeing a similar tightening in the autonomy market as well?
Boy, that's an interesting question. I have to break that down, and mentally I have to break that down in like 4 different parts here, but I don't know that we have enough time for that. But because those segments are all very different. So the bot segment, for example, there's only a couple companies in that space, and they're obviously not carrying precious cargo. They're not, well, unless you're really hungry that day, that if they're food delivery, they're not carrying passengers, and they're not carrying thousands of dollars worth of goods. But they could cause a bad accident. And so I think that underwriters looking at that are going to probably take a closer look at the technology interface with the humans and look at that very carefully. Trucking is so different because it's not going to be passenger focused. It's going to be more on, is that vehicle going to be safe for the rest of the environment that they're trucking in? So it's very different. I'll finish though with, in terms of rating, you can customize a program so that it sounds like a Liberty Mutual commercial, but it really fits with, what the business model is. And so we've learned that through transportation network companies that are out in the ride share business or ride hail business, that the risks, that vehicle, before it goes on the clock to the TNC company to start doing their day of ride sharing, they're rated differently. While they're waiting for their first passenger, they have a separate rate. While that passenger's in the vehicle, there's another rate. And when it's deadheading back to, the next passenger pickup, it could be a fourth rate. So you can truly customize programs so that, they're reflective of each of the different modes of driving. We see that in trucking as well. There could be a different rate. Ultimately, though, with data and tracking of these vehicles, all these vehicles in an EV space have kind of a digital tether, if you will, so that you're able to track exactly where they are and what they're doing. We could see down the road, really, it sounds complicated, but it might be easier as those vehicles have either a continuous download of data or a daily digital download of data, and there could be rates based on weather, whether it's raining or not, time of day, where those vehicles, what roads they're on, and the history behind accident rates on particular roads. There's so many different ways that you could get extremely precise with the rating of a particular autonomous application. So I laugh about that because as you know, I could talk another hour on that. But it's exciting because most of the, historically, you're rated by how many vehicles you have, and they just assume a certain mileage a year. They assume that it's going to be the same usage throughout the year, and they just basically how much does it cost, and it's pretty simple. And I think we're moving to a more complex rating basis. But with the advent of technology and again these digital tethers, it could be actually easier to rate these vehicles in the long run.
Are underwriters being overwhelmed by the amount of data, or are they working with contractors and in-house AI scientists to put an AI layer on top of that to properly price the risk?
That is a big TBD. I think that there's a small handful of underwriters that are going to go in deep on this thing. So I think that's to be determined. They're looking at whether they want to create that themselves, whether they want to buy that from a third party or wait for a broker like Aon to come up with a solution. I think we're still a couple years away from that, but that'll be there. It'll be there. And I think that there'll be multiple uses of that data as well, not just for insurance rating, but I think that there's some deeper value in that data that could be used by other industries.
Well, that's going to be interesting to see. We're seeing all sorts of interesting things being built upon the data. Shas Kaz, he's been on a previous podcast, the founder and CEO of Smart Car. He's doing really interesting stuff with data from cars, and incredibly smart gentleman that's doing incredibly smart things. So I can't wait to see what the insurance industry does with the data. I like the insurance industry. There's some really great, terrific companies that insure your personal risk, your car, that have incredible claims history. Are certain insurance companies and reinsurance industry companies specializing in autonomous vehicles where they've built a team of 2 people, 3 people, said, you know what, this could be a potential growth market for us. Let's put some resources there and specialize in it?
Yeah, there are. And we really encourage that. There's, again, a handful that have created, teams. I wouldn't say they're large teams, maybe 5 to 10 people or less that their jobs are full-time research and development and get into the space. But yes, and we like that commitment. And it isn't just for the people that want to ensure the manufacturers of the vehicles or the people that are going to be deploying rideshare businesses. But in the long run, all humans are going to have interaction with autonomous vehicles, whether you own one, whether you're a passenger of one, whether you're a pedestrian having to share the environment with them. And so it will be the way vehicles are underwritten in the future. We just have this period of probably 10 to 15 years where there's going to be, significant overlap in terms of human-driven versus technology-driven. And it will be similar the way the vehicles are powered as well, which is probably a whole other podcast around electrification. But we're just coincidentally, we're going to be going through that transition as well as the powertrains, the combustion engines will be phased out certainly by the end of this decade.
Well, we're going for it.
Yeah, why not?
Because now I'm interested. There are certain autonomous vehicle passenger companies that are operating hybrid with gasoline. Then you have autonomous trucks that are operating on diesel. And then you have other autonomous vehicle passenger companies working on electrification. So is it different to insure an electric motor versus an internal combustion engine?
For the most part, it doesn't matter. When you're thinking of insuring it for liability risks of people getting hurt and things getting broken or people getting hurt. And from that perspective, it doesn't matter much whether that's a combustion engine or a hydrogen powered engine or an electric, except for when you get into some of these, a lot of media attention right now around electric battery fires and vehicles. They're going to get that resolved. And this is just Stankard talking here, but for every headline you read about an electric vehicle fire, there's probably 100 combustion engine fires going on somewhere in the country that aren't being reported on. So overall, it hasn't been that big of a risk. It could be from the standpoint of the value of the vehicle, from a physical damage standpoint, if right now electric batteries are more costly than combustion engines, and so the price of those, the insurable value of those vehicles might go up. But ultimately, that's going to solve itself too, and the battery-powered vehicles will eventually become less costly to buy, less costly to operate, and the world will be a better place.
Well, there's no doubt electric vehicles are the future. They're coming. They're incredible cars. It's been well documented, though, that there have been ups and downs with battery defects throughout the whole history of this technology. And they call it a bad batch or a bad battery. Can companies insure against that if there's a defect in the battery so they don't have to, they're not out X amount of dollars they paid for that battery, that there's an insurance to cover for that? Or does that kind of go more into the manufacturing insurance at the plant?
Yeah, it's typically the risk contractually within the supply chain of the organization. The risk is very efficiently tracked back to the culpable stakeholder in the chain, if you will. And so you can insure against, if your battery causes physical damage or injury to humans, that's called product liability, and that's a classic way of insuring for that risk. What I see coming on the horizon, well, and I'll say another risk would be if there's a problem with the component part of the battery and it has to be recalled, you can insure against that. But if the complaint by the public is that the batteries aren't performing as advertised, so they're getting, instead of 300 miles per charge, they're getting 295 miles per charge. And, can you buy insurance to protect against that 5 mile an hour gap? Probably not. But there are a couple of insurers that we're in discussions with that are looking at that and looking at, is there a market out there to insure battery performance, if you will, that doesn't result in bodily injury or property damage. So I think that's be great to talk again a year from now, and I bet that's an area that will have developed.
Love to do that. And if there's an individual or individuals from an insurance company listening, Scott Case, the founder and CEO of Recurrent, is an incredible gentleman who has the largest data set of used EV battery life. It's really incredible pulling all that to look at the range based on the climate, based on the temperature. Incredible company, Recurrent. Got to give you a shout out because your data set for used EVs is truly immense, and we wish you nothing but success as you grow the business and grow your data set. Mike, I want to go back to delivery bots for a minute here. They're very hot. You have traditional restaurant companies are announcing partnerships with technology to deliver all sorts of interesting food. The Domino's Neuro one is a very public one. I think about this a lot. You see delivery bots operate on a college campus or a corporate campus that are operating on a sidewalk or a dedicated path. When you have the Neurobot that's operating on a public road. From an insurance perspective, does that change the risk if the delivery robot is on a public road with cars versus a sidewalk? I think about the delivery bots on a sidewalk. You've got a mom could be pushing a child in a stroller. Somebody could be riding a bike, not paying attention, falls, trips over it. Or on the road, it's more likely to be seen by a car. There are different risk profiles. The insurance market's pricing each one of those risks differently.
That's a great question, because while these vehicles can be very efficient in doing their task, they're not very large vehicles. And, when you're out there on a public road, you need to be seen. You need to be seen by pedestrians. You need to be seen by other vehicles that are sometimes, 10 to 20 times larger than you. So I think that the risk is different. And in a lot of cases, you think of a vehicle and you want to insure against it being the aggressor, if you will, in an accident situation, where in some of these delivery bots, it might be the opposite, and it's just they don't get seen, and they're the ones that get run over, or they're the ones that cause, an accident that has collateral damage, I guess, from that. So I think the jury's still out on that. There's so few delivery bot companies out there yet, and they're beginning to get deployed there, but it's hard to benchmark them against each other. And it's something that is just needs more time to be developed. But certainly their rating relative to a 3,000-pound vehicle and the ability of that vehicle to do some real damage to someone will certainly be considered and weighed in. But it is a strange mix of vehicles when you think about a semi-trailer to a passenger car to a bot all sharing the same roadways. It's going to be a challenge. Down the road, I think that every one of those three vehicles might end up having its own dedicated lanes.
Dedicated lanes are going to be really interesting. What we do know is that the future is going to be bright, and it's going to be fun to see what these incredible entrepreneurs and engineers build, because you and I know this. We're just getting started. We're in the first inning of a 9-inning baseball game, and we're not even at the second half of the inning yet.
That's right.
Mike, putting this whole conversation into context, what is the future of the insurance business as it directly relates to autonomy?
Well, I think the insurance business has got a huge new risk to tackle. And, unlike, I think that one of the last new risks that showed up on the scene was cyber risk, and that was cyber came on board. It didn't replace anything. It was an incremental risk to how businesses are run, where autonomy is replacing a risk. It's setting one aside, human driving, and inserting, certainly with different applications, but inserting technology to drive a vehicle. So because it's already a risk that needs to be solved for and has been solved for 100 years, I think it makes it easier for insurers to make a decision on whether they're going to get on board. Auto insurance, or in Europe it's called motor insurance, is by far the largest premium driver of the whole industry. And so for an insurer to say, I don't want a part of that going forward, I think would be short-sighted. So I think that we're in a good situation here. And I think that everybody will eventually be able to see the data that these vehicles are safer, and that will just certainly make it even more easier for adoption to this and providing adequate insurance solutions and capacity for our customers. So I'm very optimistic about it, and I'm really excited that this all came about, 5 years ago, and I've had a blast for the last 5 years working in this space.
You're going to continue to have a blast. Your optimism oozes through during this podcast, and it's really, really wonderful. But the big question that I have, I'm looking at this, you've got all this incredible optimism, you've got a large auto insurance market in the United States, motor insurance in the UK, as hundreds of thousands of autonomous vehicles, trucks, and bots come online and start moving passengers and goods around the roads and around the world. Will there be enough capacity in the insurance market to underwrite the new risk if human passenger vehicles continue to move along and sell as briskly as they have?
Well, I think it will. And what's one of those other mega trends that we're talking about autonomy, we're talking about electrification. The whole mobility trend is going to be certainly an undercurrent to all of this, where will it change the profile of the vehicle on the road in terms of who owns it? Is it being a shared vehicle? How many vehicles actually need to be on the road at a given point in time? All of that, I think, needs to be thought through, the whole economic model of vehicle ownership. So that could change the way insurers look at it. And I'll give you some examples where the traditional auto insurers that you see advertised on TV, the State Farms and Nationwides and Geico's and all that, they have dedicated themselves to providing insurance to individual consumers who own individual vehicles. They see the world changing, obviously, that, hey, those same consumers that I've been selling auto insurance to might not own 3 cars anymore, or 2 cars, or they might not own any cars, and they're subscribers to a mobility as a service model. So they're looking at that and fully aware that they need to pivot, and they need to probably be, if they want to follow the vehicles instead of follow the consumers, then they need to be insuring commercial businesses that are managing fleets of vehicles and deploying those to those same customers that they used to have. So I think that your question, I didn't directly answer your question, is there going to be enough capacity? But on that private passenger side of the industry for the motor and insurance industry, there's tremendous amount of capacity and huge companies that have built up around insuring individual consumers. And if that capacity follows the vehicles to different modes of transportation, then we won't have any problems.
That's a wonderful relief to a lot of individuals that are listening here today, that there will be enough capacity to insure the future.
Yeah. We might miss all those fun and quirky commercials, though. I know I will. They'll be targeted at fleet owners and not individual buyers. So.
And this is a question for another day, but when we talk a lot about in this house, will there even be commercials in the future as everything goes on demand and over the top?
Will there be, commercials?
Commercials.
Oh, well, there'll be a lot of people that won't miss them at all. And, if you could handpick the commercials that you enjoy, that'd be great. But unfortunately, you don't know what's coming around the corner any time. So I think that, again, with streaming and all of that, it's traditional commercials will be a thing of the past. But I enjoy the ones that are out there now. Yeah.
You're a wonderful consumer. You're a wonderful individual that understands insurance markets, who's a heck of a lot of fun to talk with. And Mike, as we look to wrap up this insightful conversation, what would you like our listeners to take away with them from this discussion?
Well, I would say I took a few notes here. I knew you were going to ask me this question.
Well prepared.
Yeah, first of all, kind of what goes on in a day in the life of Mike Stankard working in this industry is that when we think of autonomous vehicles, there's a wide array of autonomous vehicle applications, from the bots to the trucking. We haven't even talked about community shuttles, for example. So there's going to be plenty of businesses out there with different types of vehicles. Secondly, I think we just finished on that. There's going to be a vibrant insurance market to support it. I'm confident of that. Thirdly, I think that rather than what we see in a lot of ways, we'll call it off-the-shelf insurance products that fit a particular application like personal vehicle ownership, we're going to see a lot more flexibility in program structures and how these businesses are deployed, how these vehicles are deployed. There's going to be a lot more creativity in terms of ensuring different aspects of those businesses. And, again, I think we're going to be more valuable to those companies that are going to be the fleet owners, because we're going to be able to customize programs that fit the businesses, or plural, that they want to be in. And that's what everybody's looking for right now. So I'm truly optimistic for both ourselves at Aon and the customers we serve that there's going to be some great solutions out there to help protect their companies and help protect the public.
Insurance is one of the key elements for autonomy. Venture capital, private equity is another one. Without insurance, this whole industry falls apart. And there's individuals like Mike and his team that are making the future of autonomy possible, because the future of autonomy will have a positive impact on the global economy. It will have a positive impact on society. It'll be able to lower the cost of goods. It'll be able to allow individuals to go to a school perhaps farther away that a parent can't drive them to. And we all know that the future is extremely bright. The future is autonomous. And as we talked about during this conversation, the future is insurable. Mike, thank you so much for coming on the Road to Autonomy today, sharing your incredible insights into the world of insurance, which is an awesome topic, by the way.
You're welcome, and I appreciate being asked to spend some time with you today.
Awesome. Thank you very much. Thank you for listening to the Road to Autonomy podcast. If you've enjoyed listening, please rate, review, and subscribe on your favorite podcast platform. Want to get in touch? Follow us on Twitter at Road to Autonomy, or email podcast@brulteco.com. The Road to Autonomy is produced by Brulte & Company. The views and opinions expressed on the Road to Autonomy podcast do not necessarily reflect the views and opinions of Brulte & Company. The content discussed on this podcast is for informational purposes only and should not be taken as legal, tax, investment, or business advice.